So, we're going to dive into the last depreciation method that I am going to be teaching you guys, which is going to be called straight line. This is the most easiest one that you'll experience, all right? Again, you're going to have the same 5 components, and this time it's so much more easier, right? This is the last depreciation that we're going to be using. And again, straight line is actually recommended to use for corporations and approved by IRS because it is the best way to write off your depreciation at the end of the year. Right? So let's introduce you to what straight line is. Straight line is where you literally are going to take the cost of the asset and you're going to divide it amongst evenly across the useful life of the asset. Meaning every single year or every single month, whatever time frame that you're going to be calculating depreciation, it's going to be the same amount because we're doing it evenly. We're spreading it evenly across the lifespan of the asset. So if that means it's going to be in a straight line, right, every year it's going to be a constant rate, then this is going to be the easiest one that you're going to be doing, right? Now, let's take a look at the formulas that we're going to be looking here today. Straight line is a combination between units of production and double declining. How so? Well, when we take a look at the depreciation basis, it's going to be your cost of the asset minus salvage value. Where do you see this formula? Units of production, okay? And the depreciation rate for straight line is going to be 1 over the estimated useful life. Where have you seen this before? Double declining, except this time, instead of declining it twice as much, we're only doing it once, okay? So in this case, it's just 1 divided by the estimated useful life, right? The depreciation expense is going to be basis times rate. And of course, the accumulated depreciation and book value are the same formula throughout the costing methods, okay? So this one is a combination between units of production double declining. That's why I taught this one last, because now you got to see all 3 formulas and you can compare and contrast between them, okay? But again, this one's going to be the most easiest one. So let's dive into the exercise. So for this case, right, we decided to buy a machine for $15,000 with a salvage value of $2,500 with the estimated useful life of 5 years, okay? The number of units it could produce is 10,000, and the date that you place into service is January 1st. So that means if the assumption is you're going to be depreciating at the end of the year, December 31st, if we're going to start depreciating, we're going to depreciate it as of January 1st because you placed into service January 1st, which is the more than 50% of the month. This is the entire month. Okay. So for the first year, we need to solve for the depreciation basis, which is the asset cost minus salvage value. So in this case, asset cost is $15,000 minus $2,500 of salvage value. You're going to get $12,500. Then we're going to look at the depreciation rate, which is 1 over the estimated useful life, right? No times 2, okay? Because we're not double declining it. We're only depreciating it once. So in this case, 1 over the estimated useful life of 5 years. So we're spreading that's $12,500 across 5 years. You're going to get 20%, okay? Then, of course, we need to figure out what the expense is going to be. So 12 which is basis times rate, 12,500 times 20%, you're going to get 2,500. Okay? So that means accumulated depreciation is 2,500. Book value will go from $15,000 to 12,500. Okay? That's just coincidence. Okay? That your book value is equal to your depreciation basis. But in this case, that's because we depreciated by 2,500. So that's what book value is at the end of year 1. Okay? So let's go ahead and continue with year 2, right? If year 2 depreciation basis is your assets cost minus salvage value, That means it's going to be $15,000 minus 2,500, which is going to get you the same exact answer as 12,500. The depreciation rate is still going to be 1 over the estimated useful life, which is 1 over 5, which is going to be 20%. Well, what's 12,500 times 20%? It's still going to be 2,500. So what you're going to notice is you're going to get the same exact answers as the first one. Only difference is your accumulated depreciation, right? Previous years of 2,500 plus 2,500 of current year's depreciation expense gives you a total of $5,000. So therefore, your book value has now dropped to $10,000. Okay? So then what's going to happen for year 3? Well, you're going to run through the same exact formulas over and over and over until you reach the end of its life, which is in the 5th year, right? So what you're going to be noticing is that basis, rate, and depreciation expense will be staying the same for the entire time. So in this case, this is straight line, right? Once you solve for one, you pretty much can solve for all of them, okay? Now, the only difference here that when we do this is how are we going to be calculating the accumulated depreciation, which we already know, right? You're just going to keep adding the expense evenly over and over and over and over. So you're going to go from 5,000 to 7,500 to 10,000 to 12,500, right? And then eventually what you're going to notice is at the end of the life of 5 years of depreciating it, your accumulated depreciation should equal your depreciation basis and your book value should equal salvage value. All right? Easy. Simple. So if that's the case, then how am I going to journalize it for the first year? Well, you're still going to identify depreciation expense and the accumulated depreciation. But guess what? It's for 2,500. What about the second year? It's going to be the exact same journal, right? Except different year. So what you're going to notice is that for straight line, the journals are going to be identical throughout the entire 5 years of depreciating it when you continue depreciating it for the rest of the years. Okay? Any questions? Okay. Take that as a no. So in this case, right? However, when you come across a situation where partial years is going to be taking into effect, yes, unfortunately, this is one of the things that you have to also make sure that you look out for because it's very similar to double declining. This is based on this is time sensitive. So therefore, when you put it into service at a specific date, it does take into consideration, especially when you're depreciating it for the first year, you cannot claim for the whole year, right? You can only claim for how much it actually has been used. So in this case, right, if I have a $10,000 machine with a salvage value of 2,500 with a useful life of 5 years, and this time you place into service as of October 18. October 18, which is less than half the year, means you're going to start to depreciate it as of November. And if your assumption is for the first year to end the depreciation and adjust at the end of the year of December 31st, that means you can only use it for November and December of that year. So same rules are going to apply here as well, right? We're going to solve for a depreciation basis, which is asset cost minus salvage value. So in this case, 7,500, right? 10,000 minus 2,500 gives you 75,000, okay? 7,500. Rate is 1 over the estimated useful life, which is 1 over 5. You multiply that together, you're going to get 1,500. Now again, that is for the full year because again, 20% is 1 whole year of the asset, right? You have 5 years, If you're only depreciated for 20%, that's for 1 whole year. In this case, we can't treat our asset like that. It's not 1 year old. It's only 2 months old. So in this case, we're going to have to take into consideration that we need to adjust our depreciation expense for the first year. So in this case, what are we going to do? Well, we're going to figure out that 1,200 is not the answer, right? Because that's for the whole year. So how are we going to adjust it? Well, we're going to adjust it by taking the 12 months. We know 12 months is 2 out of 12, right? It's also known as 1.66667, but you're better off doing 2 over 12, right? You're going to multiply, right? Whatever the depreciation expense with the rate is, which we already know is 7,500. I'm sorry, 7,500 times 20%, which gave you 1,500. Now we need to take that 1,500 and figure out what 2 months out of 12 is. So you can either times by 2 divided by 12, all right? And you're going to get $250. So that means for the first year, you can only depreciate it for 2 months, which is equivalent to $250 opposed for the whole year for $1,500. Okay? And of course, how are you going to journalize it for the first year? Straightforward. It's going to be only for $250. Okay? Any questions for straight line? No, right? It's the easiest one, right? Because the year after that, once you figure out what the depreciation for the year, for the rest of the year is, it's straightforward, right? It's going to be the same going on from years after that. So that was 11.3, right? Very, 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 very similar to 11.2. Only differences, you're taking into consideration that there's different features or different variables that we're going to be looking at to calculate it. But at the end of the day, very similar, straightforward, because you're going to be using one number and one number only. Right? All right, so because 11.3 is straight line, let's go ahead and dive in and talk about chapter 11.4. 11.4 is what we're going to be talking about when we need to depreciate intangible assets. Now, you can't call them depreciation because they're intangible. So, what do we call them? We call this amortization, right? Very similar to land. Land can't be depreciated. It can't be amortized either. It can only be depleted. So, at the end of the day, right? Amortization, depreciation, depletion, they all do the same thing. They all devalue some kind of asset, okay? Now, in this case, depreciation is for fixed asset, amortization is for intangible assets, and again, depletion is for land, which is a fixed asset, okay, or property, okay? So in this case, let's take a look at what amortization actually does, okay? So, of course, we're talking about amortization, which is another terminology used to depreciate intangible assets. Now, the huge difference about an intangible asset is that it has some key components that actually you have to take into consideration, right? So an example of an intangible asset could be, right, you can't touch it. We obviously know that, right? That's why it's called intangible. So things like patents, things like copyrights, licenses, trademarks, even legal rights, right? Because can you really touch a license? Can you really touch a copyright? What is a patent? A patent is just a protective field over an idea. Can you touch an idea? Of course not. Can you even feel that invisible force that is on that idea? No. You can't. It's imaginary, right? So the only thing that you can't touch is just the paper that you signed that has legal documentation proof that you own it, that you have ownership over it. But at the end of the day, that's not what you're looking for. You're not touching the paper. You're touching the idea of what it represents. So in this case, a protection field over an idea, which is a patent, right? Can you physically touch that? No. So that what makes a key feature that why we use amortization is because Patents don't last and hold its value over time, right? It's the same thing, right? You're going to end up having to renew your license, right? You have to go to the legal statement and renew your copyright, renew the ownership of your trademark. So again, that's the huge key word here is renewing. Nothing lasts forever, right? So if that's the case, if nothing lasts forever, then these are the key features that you need to be aware of, okay? So that means when you purchase your intangible assets, right, we understand this. It should not hold a value at all at the end of its life. Why? Well, what's the point of renewing a license or a patent? Because it has an actual expiration date, right? So if I decide to, again, let's say for instance, right, I want to renew my subscription. My subscription is for 1 whole year. So at the end of the year, does it hold any value? No, because you have to pay for a new renewal subscription for it to add value to it, right? So that's the idea here, is that there is no salvage value. So how do we calculate amortization? We're going to treat it like it's straight line, okay? The only difference is there's just no salvage value. So if it's exactly like salvage value, or if it's exactly like straight line, then how do the formulas differ? Well, amortization basis is going to be your asset cost, right? Because you have no salvage value. So therefore, it's just your asset cost. What is the amortization rate? Well, if for straight line, it's 1 over the estimated useful life, that's the same thing here. It's 1 over the estimated useful life. How do you solve for amortization expense? Basis times rate. So in this case, cost of the asset times the rate. And the amortization, accumulated amortization and book value, these are going to be exactly identical to the depreciation, except the different terminologies are replaced, right? So instead of referring to depreciation, you just swap it out for amortization. And that is the same exact thing. You're going to take your accumulated, previous accumulated plus your current expense, and that will give you your accumulated, and then your book value is going to be your cost of the asset minus the accumulated. Okay? So let's do an example right here where we decided to purchase a $20,000 patent, okay, on one of your prototypes, okay. And of course, if you want to sell it to your store on January 5th. So here's another thing too. The date that you place it in service is going to be immediately effective, because that's the thing about patents, is they start as soon as you file for legal protection over something, it's effective as soon as it gets approved. So in this case, starting January 5th, so in this case, same rules apply. It's more than 50% of the month, so therefore you're going to start amortizing as of January 1st. Okay? So in this case, how do I solve for the amortization for the first year? Well, let's see. Amortization basis is going to be cost of the asset. In this case, $20,000. Right? Next is going to be the amortization rate, which is 1 over the estimated useful life. So in this case, typically, intangible assets, especially patents, licenses, and things like that, right? Their years vary on what you're protecting, right? So you can protect a license for 1 year. That's the common one. You can either protect your license for 5 years, 10 years. I know Disney has one for 50 years, right? They want to keep all of their, Disney princesses, Disney cartoons. All of that is secured for 50 years. So if a patent, license, copyright can be protected for either 1 to 50 years, we said, guess we'll just pick 15. Okay, because 15 can represent either a long term of licenses, or it could be a short term license, right? So in this case, 15 years is usually just a guesstimated rough estimate. Again, it would just depend on what the product is, or I'm saying what the protection is. So in this case, if I want to protect my patent for 15 years. So there you go. 1 over 15 years is going to give you 0.06666. Right? So then we need to solve for the expense, which is going to be your basis times rate, which is going to be the 20,000 times the 0.06666 will give you $1,333.33. So then, same rules apply for the accumulated. For the first year, it's going to be whatever the current is. Book value is going to be $20,000, which is the asset cost, minus the accumulated. So you're going to get $18,666.67. Okay? And then we rinse and repeat for the second year. What's my asset cost? $20,000. What's my estimated useful life? 1 over 15 years, right? What is my 20,000 times 0.06667? $1,333.33. So that means you understand, right? It's similar to straight line where you solve for one. The rest of the answers are just going to be the same exact every year until you completely used up the asset for the estimated useful life. Okay? All right, and then how do you journalize it? So instead of depreciation, we replace the word depreciation and we stick in amortization. So you're going to have amortization expense and you're going to have an accumulated amortization. Okay? So then you plug in your numbers and that's it. So chapter 11 review. Once again, we talked about straight line and we talked about how amortization is exactly identical to straight line. Only difference is you don't have a salvage value. Right? Now, again, the difference between the two, again, straight line is where you're spreading the cost evenly amongst over the estimated useful life, where amortization is meant for intangible assets. But you do essentially do the same thing. You're spreading the cost evenly amongst its estimated useful life, and then you depreciate it every single month evenly. Right? Okay, so let's dive into the exercises. Okay, so let's dive right in. So this one has 3 sections here. So questions 1 through 3 again. This time we're taking a look at our table here, right? Question number 1 says that you end up purchasing a coffee maker for $250 with no salvage value, right? And it has a useful life of 5 years, right? And a plus, it can produce up to 25,000 pots of coffee, okay? And of course, you put this coffee maker into service as of January 12th. So, assuming that you're going to depreciate at the end of the year, December 31st, you're going to be depreciating it as of when? January 1st. That means we're going to depreciate it for the whole year. So, let's identify our variables. So, here we go. What did I buy?
Coffee maker.
You purchase a coffee maker. Okay, how much did the coffee maker cost you?
$250.
$250. Okay, and what's the salvage value on there?
0.
0. There's no salvage value after this coffee maker. And what's the estimated useful life?
5 years.
5 years. So, when did you place into service?
January 12th.
Correct. Okay. So, let's take a look at the very first one. What is the depreciation basis going to be?
It'll start at 250.
It will start at 250 because you don't have a salvage value, right? So in this case, the asset cost of 250 minus the salvage value of 0 is still going to leave you with 250. Right? All right. What's my rate going to be?
1 divided by 5.
We're just going to give you
50%.
not 50%,
20.
20%, right? 1 divided by 5 is 20%. Okay. All right. So then what's my depreciation expense going to be?
$50.
Okay. So we're going to take my 250 and we're going to take 20% of that, and that's going to give me $50. So what's my accumulated for the first?
$50.
It's going to be 50, right? Because we are, nope, we don't have previous years. So in this case, it's going to be 50. So then what is going to be my book value for my coffee maker at the end of year 1?
200.
200, right? Because it's my asset cost of 250 minus 50 will leave you $200. Okay. So what's my depreciation basis for the second year?
250.
250. What is it going to be for the third year?
250.
250. So therefore, right? They're all going to be 250 because the formula does not change, right? It's still going to be asset cost minus salvage value. So in this case, it's always going to be 250. What about my rate?
Stays the same.
It stays the same, right? It's still going to be 1 over 5, which is 20%. So 1 over 5 for every single one of them is still going to be 20%. What about my depreciation expense?
Gonna stay the same.
It's going to stay the same because 250 times 20% is going to give you another $50. Okay? Same thing for year 3. 250 times 20% is still going to give you $50 at the end of the at all 5 years. It's going to be $50. So the only difference here, or the only thing I'm really calculating, is just the accumulated depreciation and book value. So in this case, what's my accumulated depreciation for year 2?
100.
100, right? 50 is the previous year plus 50 of the current is going to give you 100. So what's my book value going to be for my coffee maker at the end of year 2?
150.
150, right? 250 minus 100 gives you 150. All right. What about third year? What's my accumulated for third year?
150.
Okay. Book value?
100.
100. Right? Accumulated for fourth year?
200.
Good. Accumulated, a book value for year 4?
50.
50. So then, accumulated for the 5th year? What's 200 plus 50?
250.
250. So then book value is going to be 250 minus 250 gives you
0.
0. So in this case, this one's straightforward and pretty easy, okay? So, question number 3, question number 2, and question number 3 says, record this adjustment entry for the first and second year. So how am I going to journalize my depreciation for the first year?
It would be it'd be $50 on debit, but you'd first write depreciation expense.
Excellent, right? Depreciation expense for $50. Okay, and what's my credit account?
It's depreciation.
What word goes before it?
Accumulated depreciation.
There you go. Accumulated depreciation. 450. So in this case, that's year 1. What's my year 2 journal going to look like?
It'd be the same depreciation expense and accumulated depreciation, but the numbers would be the same 50.
Correct. Because in this case, right, because you're depreciating it every year for the same amount every year. So in this case, second year, it's also going to be $50 debit, $50 credit. Okay. All right, so that was the first one. So let's go ahead and take a look at question number 4. And this one, you need to pay really close attention, okay? So let's see. We decided on, so question number 4, we decided to purchase a couch for $2,485, okay? Which includes all fees. All right, and of course, with the salvage value of $150, okay, and its estimated useful life is 7 years, okay, and you put this couch into service as of August 25th. Assume that the adjustment entries are done at the end of each month. Okay. So, what's my depreciation basis? Or well, let's solve for our variables. What did I buy?
Couch.
You bought a couch. Right? How much did the couch cost you?
$2,485.
$2,485. Okay. What's my salvage value?
$150.
$150. Okay. What's my estimated useful life?
7 years.
7 years. So estimated useful life is 7 years. Okay. And when did I place this couch into service?
August 25th.
August 25th. Okay. So let's go ahead and solve for my depreciation basis. So what's my depreciation basis going to be?
It's going to start with 2,485.
What's the formula?
Wait, no. Oh, no, the 150 because it's the salvage value.
Yes, right? But which number am I taking? Am I taking 2,485
No,
or
you're
150?
taking 150. You're taking 150 because that's salvage value. And that's what your base is.
My basis is not my salvage value.
So you take the 2,485 then? Or you would...
What's the
Or
form?
you minus the 150 to the 2,485.
Correct. So in this case, 2,485 minus 150. What do you get here?
2,335.
2,335. So that is my depreciation basis. Okay?
And that's going to be the same for the whole thing, right?
Yes. For all 7 years. Okay? All going to be the same. Okay? What about my rate?
The rate's going to be 1 divided by 7, so 0.14.
0.14. In this case, it actually goes 0.1428. Yeah, so in this case, it's going to be a rough decimal because 7 is not an easy number to divide by, okay? So, what about my rate, though? What's unique about my rate? What's going to happen to my rate for the next year?
It's going to be the same for everything.
It's going to be the same for everything. Good. All right? So now let's go ahead and solve for my depreciation expense. So I'm going to use my equal round formula here.
16,345.
Is that true?
No,
Why?
because it's way too. The number is way too big. It's over. It's way over the depreciation basis. And can it not be over that?
Actually, hold on. Let's do that again. Because that's not. That's not. Wait, hold on. Let's do it again. So we got 2,335, and we're multiplying it by the 14%. Shouldn't give you 16. Should give you $333.57. I don't know what you and I just did, but anyways, it's not 16. It's $333. Did you multiply or divide?
I divided.
Okay, so go ahead and recalculate then. $2,335
Well,
times. You're not dividing. You're timesing.
oh, times so 235,000 times the rate
Mm-hmm.
equals 330.
Yes.
I got 334.
Your count. You might have rounded the number too. If you only put 1 4, then it's gonna round your numbers up.
So was I not supposed to put equal round?
You can do equal round, but your formula here needs to be 1/7.
Yeah, it is 1/7. 1/4.
Okay, so then that means you have in your display options, you need to show all decimal points. So we'll change it to 334 because it's 333.5, right? That's gonna round your answer up to 334. So you need to show the cents in this one.
Okay.
So it should be $333.57. Now, is that true?
Yes. Wait. Yeah, it would be true.
So in this case, if I divided this number by 7, how much is this expense for? Is it for the year? For the full year? Yes. Question.
No, I was going to say because it went to service in August, at the end of August.
Okay.
So we don't have the full year of use for the first year.
Okay.
So we actually have to claim only partial months of the year that it was in service.
Okay, now, I see where you're going for. That is half correct. Why is it half correct? Because you are on the right lines. We're not supposed to be depreciating for the whole entire year. When am I doing my adjustments at the end of?
For the year, we do it at the end of December.
Does it say I'm doing it for the end of the year?
No. Oh, no, it said adjustment at the end of every month.
Correct. So in this case, this is for one whole year. How do I just get for just that 1 month?
So for the depreciation expenses, first month, so it needed to be divided by 12.
You just divide by 12. So in this case, I'm only looking for not for the whole year. I'm just looking for 1 whole month. So in this case, what's my depreciation expense for the month? Or for the first month in this case? So what's $333?
Divided by 12 is $27.80.
$27.80 for the month. Okay? Now, question is, am I going to consider partial years?
No, because we're adjusting every month.
Exactly, correct. You're correct there where we need well we're not doing partial years because that's not what I'm looking for. I don't care if I put it into service as of August 25th because it's not going to matter to me because I'm not going to be calculating partial years. I'm calculating at the end of every single month, okay?
So if that number, so say we have another problem and it shows like a big number like that again, we just divide it by a year and we'll always get the right answer for depreciation next month.
Well, it depends on what the question is asking you. Am I depreciating at the end of the month or end of the year?
No, yeah. So if you're doing it by a month, would you what would you do then?
Well, what is my monthly expense? How do if the formula is meant for you to solve for every single year, how do I get my months?
You divide it by 30 or 31.
That's days.
Oh, so you 12 months.
12 months.
Oh, and it, but for a year.
If this was a year,
Oh, this. Oh, yeah. Okay, I forgot. This is a month. I meant to say if it was a year.
if this was on a yearly basis, then yes, unfortunately, you're going to have to take into consideration for partial years.
Oh, so you would do every quarter then. So you first figure out what the quarter was or half year, and then you'd do that.
Right, because in this case, if I put it in service as of August 25th, I don't start depreciating it until September, October, November, December. So for the first year, I can only record 4 months.
Okay.
hmm But in this case, I'm not, in that case, yes, you would have to take into consider partial years. We have a billion examples of partial years. This one, I want to test you. Are you able to recognize if I didn't ask you a partial years question? What if I told you, tell me what the depreciation is for every month? Are you able
Right.
to recognize that? So in
Yeah.
this case, we know how to do one whole year. So how do I go from 1 year to a month? Well, we know 12 months equal 1 year. So in this case, that's exactly what I did. I took the depreciation expense, which was for the whole year, divided by 12 to get me my monthly depreciation.
Oh, okay. So the number. So if it was year, it would stay. If it was say the question was year, it would stay 333.
But that's for the whole year.
Yeah. So okay, I'm getting one. I'm getting it.
Okay. But that's for the whole year, though.
Right.
But in this case, if I put my machine, or in this case, it's a couch, right? I put my couch into service as of August 25th. I mean, I purchased it at the end of the year.
Oh, so you'd have to calculate the the rest of that year first, and then you would.
That's correct.
Okay.
Mhm. But in this
So you
case,
would you add that number onto the next year, or how would you do, or would you calculate both numbers separately and then add them together?
what do you mean by that?
Like say it was for the last 4 months you have to calculate, right? Would you calculate that 4 months and then calculate the next year and then add the number together to get your value? I mean your depreciation expense.
That's for the accumulated.
Oh, okay.
So take a look. If you want to, we can take a look at for the previous example when we did double declining, right? What happens when we had partial years, right?
We
So if the first year I only put into service for 3 months, right? If I continue to keep depreciating it, right? That means I'm going to start depreciating it as of January 1st all the way to December 31st. So that's one full year
right.
for the second year. Okay? Again, think of it like children. If someone has a birthday on August 25th, right? And we just say, okay, well, we don't count August because you only have like 5 days left, right?
Right.
So we treat you like you were born on September.
Okay.
But if I start saying I adjust at the end of the year,
Oh, so
December,
you don't count that. You don't even count those 4 months. You just start on the second year.
you do have to count those 4 months because you still use it. It's like saying, okay, if you have a cousin, okay, they're born September 1st, right? And it's
Mhm.
December, it's Christmas, right? Can you say happy birthday to that kid?
No, because
No,
you're born
but how do you count? How old is that kid now?
3 months.
4 months.
I mean,
September,
4 months.
October,
Oh,
November,
okay,
December.
4 months.
So in this case, right? But then what if it's the next Christmas? Can you say that person is a year old now?
No, you'd be a year and 4 months.
A year and 4 months, exactly.
So you would just add those 4 months onto that next year.
For the accumulated, yes.
Okay. So you would do what? 14 divided by, or not divided by, or you do 14 times whatever the. All right. How would you calculate that though?
What do you mean?
How would you do that on Excel? Like how would you go about doing that? Like what would the formula for that be?
Well, in this case, the first year's over. You don't even consider it anymore.
Okay.
So that 4 months that you already depreciated for that year, that's it. You move on to the next year. So how do you depreciate for one whole year?
You would do from the beginning of the year to the end of the year, so that'd be 12 months.
Right.
So
Can I hold that question till after class and I'll go over that with you? But for
yeah,
now, let's just finish this up and then we'll go over that problem again with you after class, okay?
all right.
So in this case, I'm looking at a month-to-month basis, right? Since I'm depreciating at the end of the month, my first month is going to cost me $27.80. So then, what is going to be my accumulated depreciation for the first month?
It would be
Do I have a previous month?
no, you don't. So it would just be 27 then.
It would be just be that $27.80, okay? So then what would my book value be then?
Cost of asset minus accumulated depreciation. So
Mm-hmm.
it'd be equals minus 2,457.
Good. Okay. What about the next following month?
It'd be the same thing, right?
Why would it be the same thing?
Because all the numbers are the same. We have the same accumulated depreciation, same depreciation expense. Because wait, no, it wouldn't be. For the next month, it'd be.
Go
You're
ahead.
talking about the accumulated depreciation for the next month or the book value for the next month?
I'm talking about the depreciation expense for the next month.
Depreciation expense. It would be times rate. So
How would I solve for my monthly depreciation expense?
depreciation basis times the rate. It'd be the same thing. It'd be 2780.
How did you get 2780?
Because we whatchamacallit, we times the depreciation rate basis, which is 2,335, times the rate, which is 0.14, and it's the same number because they're all the same number. So
Well, do that calculation again. How is $2,335 times 0.1428 gonna give me $27?
because we divided it by 12.
Because we divided by 12. Excellent. That's what I was trying to understand. Do you understand that? Because I'm looking for a monthly basis, right? Just
Right, yeah.
multiplying the basis and the rate is only going to give me for the full year. I'm not
Right,
looking
yeah.
for the full year. I'm looking for the whole month. So in this case, I divide by 12 to get me the $27.80, and that's correct. Since it's straight line, we know for a fact that it's all going to be the same every single month in this case because that's what we're doing. We're going to be dividing it by 12 every single time. Okay? So in this case, now the only thing that we're really solving here is the accumulated depreciation in the book value. So in this case, what is my accumulated depreciation for the second month?
Same thing, 27.80.
In this case, this is for the second month. Did I have a previous year's accumulated depreciation
No.
for the first year?
Well, no, you did. It was
For the first
150.
month?
Wait, no, wait. Yeah, for the first month it was. Are you talking about the book? Wait.
I'm talking about accumulated depreciation. Break down the word accumulated depreciation. What does accumulate
Oh,
mean?
so plus the you add that plus the previous year's accumulated depreciation. So it'd be 27 plus
What's my current?
2780.
Okay. So what's 2780 plus 2780?
Is 55.6.
Okay, 5560. Good. So now what's my book value now?
It'd be the cost minus the 2,424 or 29.
Yes. Okay, what about my accumulated depreciation for the third month?
For the third month, it'd be the previous year's accumulated depreciation, so 55.60 plus the current year's 83.40.
83.40. Good. So then what's my book value going to be? $2,401. So in this case, it's going to be rinse and repeat. You're just going to keep adding your depreciation expense to your previous accumulated, right? So in this case, I'm going to go ahead and fast forward and just go through, drag my formula down. So this is just me keep adding and adding and adding to my previous to get my end result. And this one, I'm just going to keep subtracting out my accumulated. So by the end of the 7th month, it's going to tell me my book value is now $2,270 or $2,290.40. Okay, so that's the end of the 7th month. So let's answer these questions one at a time. For question number 5, record the adjustment entry for the month of August of the first year. So what do we need to record for the first month, August of the first year?
2780.
Why would you put 2780?
Because that's the first month's depreciation expense.
Well, in this case, when did I put my asset into service?
August 25th.
And using the rules of the date in service, when do I should depreciate this asset starting on?
The beginning of the next year. So it would be
Not beginning of next
the beginning of
year.
next month, September. So it'd be September 1st.
Correct. So my question is here is I need to record the adjustment for the first month on August of the first year. So what should I journalize for August? Do I need
55.
do I
No, you don't.
need to depreciate for the month of August?
Oh no, you wouldn't. So you'd be 0 then.
Good. So in this case, you would have no entry because you don't start recording depreciation until the following month, September. So that's what question 6 asks. So now I say, record the adjustment for the month of September of the first year.
That's when we start doing 2780.
That's when we start doing 2780. So in this case, now it's September 30th. So what am I needing to record?
Debit 2780, but first you'd have to write depreciation expense.
For
And then for
2780.
credit, you'd write accumulated depreciation.
Excellent. Okay, good. All right.
And it'd be the same thing. It'd be the same number for credit too.
Yes. Okay. Now, here's another question. Question number 7 says, okay, record the adjustment entry for the first year, okay? Assuming that the depreciation adjustments entries was done at the end of the year, December 31st, okay? And was calculated annually. Okay? So this isn't asking you a different question now, right? You're not recording what it was on December 31st according to that month. You're doing it according to the year for the first year. So
it'd be
how?
the first number we solved, which is 333, before we divided it by 12.
Well, 333 is a full 12 months. That's one for one whole year. But I'm talking about
Oh, because
depreciating
we
for the
started it
first
on
year.
August. That technically counts as the first year, so it'd be whatchamacallit, 4 months because we start on September 1st because we're not counting the last couple days of August, right?
Correct.
So we do what?
How did we do it before?
Oh, so we times the 4 divided by I mean not 4. We do 4 times the rate.
Not 4 times the rate.
Would be 5, even though we don't count the last.
So in this case, right, how much is it for a whole year?
It'd be 333 for a whole year.
333.57, right?
Right.
That's for the whole year. I only need to get 4 out of 12 months. How do I figure out what 4 out of 12 months is going to give me?
Oh, you divide 333 divided by 4.
Not divide by 4.
Divided by to figure out a quarter of it once you just do it, so you do it by
Is 4 months a quarter of a year?
no.
What is 4
So
months to what is 4 months out of 12? How much of a whole year are you actually calculating?
Like
What's 4 divided by 12?
0.3.
It's a third of a year, right?
Right.
So you can choose to either divide the whole thing by 3, right? Because you only need a third of the year. Or you can do this where you multiply by 4, but you have to divide the whole thing by 12 to get you your 4/12 of a year. The third way you could do it is you can divide the whole thing by 12 to get your monthly depreciation and then multiply it by how many months you used. So in this case, how many months did I use for the first year?
4.
So let's take a look at my table. I already calculated what my monthly.
Oh, so 2780 times 4,
Yes.
which is 111.
Yes. There you go. That's for the first year. Because in this case, we only used it for 4 months. So that means I cannot calculate it for the whole year for $300, right? I can't say my cousin is a whole year's old when they were born on September 1st. No, because that's not true. So that's the same thing here. We got to consider how old is my asset? How much out of the whole year did I actually use it? In this case, I only used 4 months out of the 12. So in this case, if I were to do it for December 31st for the whole year, I can only claim 4 months out of 12. Right? But in this case, if I follow the other way around where I divide the whole thing by 12, like what I was doing, right? And I multiply it by how many years or how many months I used it for, which is 4 times 27.8, gave you that 111.2, which is correct.
So we debit that and then we credit that.
Mm-hmm. Okay. All right. So last question for this right here is going to be question number 8. We're going to practice an amortization question. So again, I'm not going to make you do all 15 years. Okay, so I'm just going to make you just do the first 5. So in this case, right, we're going to be amortizing. Okay, so on January 12th, you decide to purchase a copyright for $2,500 and its estimated useful life is 15 years. So let's identify our variable. So what did we buy?
A copyright.
You purchased a copyright. Okay, how much did that copyright cost me?
2,500. Yeah, 2,500.
$2,500. Good, right? In this case, there's no such thing as salvage value, right? Because copyrights have an expiration date. At the end of its life, it has to be 0. So there's no salvage value possible with any those types of intangible assets, right? What's the estimated useful life?
15 years.
15 years. And when did I place it in service?
January 12th.
So what does that tell me? Am I going to depreciate January or February?
February.
Why February?
Because we don't count the rest of the days of January because we started already in January, so we just start on the next month.
Well, what's the rule here? Did I use it for 50% of January or did it use less than 50% of January?
Oh, less than 50%, so we just calculate as if it was the first, right? The 1st of January?
1st of January because we used more than 50%, right? What was the 50% means if you put it into service as of the 1st and the 15th, that is way more than half the month.
Right.
Right? So in this case, we do need to treat this as if you're going to depreciate it for that month because you used it for a majority of that month. So therefore, you need to consider depreciating it as of January. Okay? So in this case, I'm going to be depreciating it as for the whole year. All right? So what's my depreciation basis? Or in this case, amortization basis.
It'd be 2,500.
Right. It's just the asset cost because we have no salvage value. Right? What is my rate going to be?
Divide that number divided by 1. So
What number?
2,500 divided by 1. So that's
No.
oh, not my fault. I apologize. 15.
Yes, 15. 1 divided by 15, what do you get?
0.7.
Okay, in this case, it's 0.6666666666666. So if you extend that number, it's going to be a bunch of 6s, okay? But there's a 0.0666666, okay? So therefore, I'm going to use my equal round formula for this. So how much is it going to be for my amortization expense for the first year?
We do the depreciation basis times $166.
$166.67. So what's my accumulated here?
There's no previous year, so we just current.
Which
So
is
it'd be so it would just be 166 because there's no previous year.
good, right? So then what is my book value going to be?
Cost of assets. asset minus the depreciated value. So it'd be 2,500 minus um, the 166.
Mm-hmm.
So it'd be 2,333.
Good. Right? So then what about the next one?
It'd be the same depreciation. It'd be the same. All the numbers for depreciation basically would be the same.
Good. And then rate
Would be the same thing too.
would also be the same. Oops, in this case it's not. Okay, I know why. Okay, so then this should be all the same. So then what would be my amortization expense?
166, same thing.
All right, it will all be the same. So the only thing that I'm really solving here is just my accumulated depreciation or accumulated amortization. So in this case, what is my accumulated amortization for the second year?
It would just be 166 plus the book value.
Not
The
book
last year's
value?
last year's no by the asset cost. So it'd be
No. We're looking at accumulated.
minus. It'd be minus accumulated depreciation minus the cost of the asset. So it'd be
That's book value.
oh yeah, previous year's accumulated depreciation plus current year's depreciation
Mhm.
expense. So it'd be 166 plus 166.
Yes. But don't forget the 67 cents because that's going to change your number by $1.
So the number would be 333.33.
Yep, 3334. Right? So then that will give you a book value of.
It would be a book value of 2,166.
Okay, good. So then let's do one more and then we'll just copy the answer all the way down. So in this case, what's the accumulated amortization for the third year?
500.
Okay. So then what is, it should be 501 because you have 4 plus 7. Okay. So then what's my book value?
2,000.
199.99. Right, because you have that 1 penny.
For some reason, when I calculated on here, it's just not counting that penny.
It's because, think about it, 33333, right? You're not rounding it up on your end. So in your books, it's still counting as 33333 plus 66666 is going to give you an even number. Where that's not what it is here. Because we need to round up because you can't journalize in your journal that you're going to depreciate for 0.33333 cents. You have to say, I'm going to depreciate it for 0.34 cents.
So whenever I was supposed to add the two numbers together, I was supposed to equal round it.
Yes.
So let me do that. Equal round.
Okay.
166 plus.
Or in this case, if equal round is too complicated for you, just go ahead and just type in the number. So if you're going to do 166 plus 67 plus 166.67, you should get 0.34 cents, right?
Yeah.
Because 7 plus 7 is 14. Then you could just type that number directly into your Excel spreadsheet. So instead of me doing my equal round, I can simply just go type it in there. 166.67 plus 166.67. The only problems with that is you could make a typo and you may have to fix everything if you make that accident typo. Right? All right, so good. So that means for 4 and for year 5, you're going to get these numbers here. And book value is also going to be these numbers here. Okay? So last 2 questions of the day is going to say, let's record the adjustment entry for the first and second year. So in this case, how do I record an adjustment entry for amortization? Yes.
So instead of calling depreciation expenses, we needed to call it amortization expenses on
That's
the account.
yes, because this is an intangible asset. Yes. Good. Amortization expense, and what's my credit account?
Whatchamacallit, amortization, accumulated
Amortization.
amortization.
Yeah, there you go. Good. So amortization, good. Right? That's the only difference is your journals are identical. The only difference is you need to recognize amortization instead of depreciation. Okay? So in this case, amortization expense and accumulated amortization. So what am I going to be doing for the first year? How much am I debiting?
166.67.
166.67. And then you're going to credit for that 166.67. Okay. So then
Number 10 to be the same exact thing because they're all the same numbers.
exactly, right? That means for the second year, you're going to amortize it for the same exact amount. Okay? All right. Good.